Hey everyone, welcome to Alpha Insights. I'm Daniel Snyder from Seeking Alpha. Thank you so much for tuning in this critical time of the market as we go into the end of the year. We're still wondering, is this the beginning of the Santa Claus rally? Is this a fake out? Is there a bear market looming around the corner? Inflation's running hot. Inflation number is coming around the corner. So we have a great panel with us today that we'll get to in just a moment. But before we start, we always like to look at what the markets have done year to date for perspective. So running down the list, we have the Dow Jones up 15%, the S&P up 22%, NASDAQ up 18%, Bitcoin is up 74%, and Ethereum is up 491%. A little bit of a pullback there within the crypto market as well as the rest of the market. And joining me today is Eric Basmachin from EPB Macro Research, Chris DeMuth Jr. from Sifting the World, and Brad Thomas from REIT on Alpha. As always, it's so great to see you, gentlemen. Thank you so much for coming in and chiming in with your opinions and sharing your great insight. We're going to start where we always do, the macro view. Eric, we're going to come to you first because we got to know inflation is coming around the corner, but you put out a really good note at the end of last week saying that the Federal Reserve is making a policy error. And those are pretty strong words. And I think you were referring to the tightening in the environment of deaccelerating growth, right? And you've been talking about this for the last few weeks. So why don't you just go ahead and give us a quick breakdown? Why the strong words? Why put it in such a strong sense? Are you just trying to make a point, or is there something more to this?
Sure. And thank you for that lead in. In the comment section to that note, I want to clarify one thing that I meant. A lot of people rightfully pushed back on that comment saying, how could you say it's a policy error? The zero rates are not helpful. And that is true. There are a lot of negative consequences of having extremely low interest rates and quantitative easing. And if we go back over the last 20 or 30 years, you could say that the original policy error was not policing the leverage that was building up in the system. We have almost 400% aggregate debt to GDP when you look at public and private sector. So you can absolutely make the point that the original policy error was allowing the situation to get to where we are now. But with that being said, the statement that I was making is that where we are now with aggregate debt to GDP close to 400%, the Federal Reserve is not going to be able to tighten policy without exacerbating the ongoing slowdown. So when I talk about economic growth, I talk about it in a very objective, empirical sense. It's not my opinion. It's just a observation of what's going on with the data. And if we look at what I call the four corners of the economy, we look at industrial production, real consumption, real income, and employment. And we look at the composite of those four. The growth rate of those four indicators peaked at about 7.5% in March of 2021. And since that point, we've slowed from about 7.5% to about 3%. So in markets, the only thing that matters is what we call the rate of change, or the second derivative. It's that direction of growth. You can't look at it and say, well, 3% is good or 3% is bad, because it all depends on where we were coming from. And we were coming from 7 and we're moving towards 3. So that's a deceleration in growth. And we can look at leading economic indicators to give us an idea of where that growth rate's headed, and that growth rate is still headed lower in real terms. So when the growth rate in the economy is coming down and the Federal Reserve tries to tighten policy, you're adding double pressure to the economy, and that's going to reinforce the slowdown that's already going on. And we can see the policy error manifesting most specifically in the yield curve and the US dollar. And the yield curve is not just a signal, it also has economic consequences. You could look at basically any spread that involves long-term rates, whether it be 10-year versus 2-year rates, whether it be 30-year versus 5-year rates. All of the long-term measures of the yield curve are flattening, and the flattening is getting increasingly aggressive with every incremental comment from each Federal Reserve official that they're going to accelerate the pace of the taper. We see that flattening accelerate. So that reinforces the policy error that I'm speaking about. And when the yield curve gets too flat, that starts to restrict bank lending and it starts to choke the economy of credit. So, and then the second place that you could see that is in the U.S. dollar. The U.S. dollar, the death of it was declared numerous times earlier in this year, and now we see the dollar rising pretty strongly against almost every currency over the last 7 or 8 months, which is going to put a deflationary force on the U.S. and global economy. As far as the inflation print, however, we are expecting the inflation print to accelerate again. So we talked about real growth is trending lower, the inflation rate is trending higher. Based on the way I calculate it, which is a 6-month annualized growth rate, it's a little bit more timely. The inflation is going to be anywhere between 7.9% on a 6-month annualized basis and 7.1%. So we still have some really, really high readings. But what we have to consider is that if inflation surprises to the upside, what that means is real income is gonna drop. And we can aggregate measures of real income from the employment report, which came out last Friday. And if inflation comes in at about consensus, we're looking at real income growth at about 1.8%. And that's not all that much better than it was the last 10 years. And the Federal Reserve really struggled to get off the zero bound. So if we have real income growth at 1.8% again, the Federal Reserve is going to find it just as difficult to get off the zero bound again.
Yeah, and that's a great point. I mean, you brought up the taper. We obviously want to talk about the taper and the speed of the taper. And it almost feels like we do need to have that accelerated speed of the taper a little bit. But then a lot of people are saying, oh, well, maybe interest rates will come in faster. Why is no one talking about a scenario where maybe we would just taper and they take out all this bond and mortgage buying and then we just sit with interest rates near zero? I mean, it kind of feels like we're never, like you said, getting off the bottom. It feels like we might just be at zero interest rates, well, close to zero interest rates.
Yeah, that's a great point, and I'm glad you mentioned that. And several months ago, back to the summer, when the Federal Reserve first started talking about this taper, they tried to de-link tapering from rate hikes. They tried to say we're going to separate the two and we're going to talk about tapering first, and once the taper is done, then we're going to move to raising rates. And they used all this terminology saying that there's a more stringent test for rate hikes than there is for tapering. But the market sort of called their bluff on that, and they lifted the short-term rates anyway. So the problem is that the Federal Reserve is having a hard time with forward guidance. They can say we're going to taper, but the problem is the market's already raised the belly of the curve, the 2 to 5 year rate, to anywhere between 70 basis points to 125 basis points. So the market's already raising rates for the Fed. And when you look at any of these yield spreads like 30s 5s or 10s 2s, that flattening is reflecting the tightening that the market's already building in. So if the Fed wants to do that, and they could engineer some easing here, if they specifically say we are going to tighten, but we're not going to raise rates at all through 2024, let's say. If they come out and make a statement that's that bold, then they'll smash the front end rates, the 2-year, 3-year, 5-year rates. They'll bring those down, but they're not doing that. They're trying to walk this game of accelerating the taper, but not beating down the belly of the curve. And then the market's taking that and actually raising these rates ahead of the Fed. It's getting ahead of their tapering plans, and it's causing quite a bit of tightening into slowing economic growth. And we're seeing that manifest through all of these risk assets and treasury rates and FX markets as well.
Yeah, and it feels like that way because investors, I feel maybe we can all agree on this, is we're getting more used to volatility to a degree. And maybe that's because of the crypto markets, or maybe it's because of the stock market, or with COVID, who knows, right? But the volatility seems to be here to stay. Now, I want to touch on this quote that you had in your recent note that I touched on earlier. It said, when economic growth is declining, it's historically prudent to shift into defensive assets like long-term treasury bonds and more defensive parts of the equity markets like utilities, large cap, and quality balance sheets. Now, I read that and I started looking and I noticed the XLU has been almost back at all-time highs for the entire year. Apple has been soaring lately. That would be a large cap and quality balance sheet. Does it feel like our market is split right now with everything that's going on?
Yeah. So, in my service, I run back tests and try and parse what assets do well in these different environments. So if you go back to that measure that I was talking about earlier, those 4 corners of the economy, industrial production, consumption, income, and employment, and we look at, like I said, the rate of change. Is the growth rate increasing or the growth rate decreasing? If we go back over the last 30 years, 90% of the gains in the S&P 500 have come when the economic growth rate is accelerating. Only 10% of the gains have come when economic growth is decelerating. And the craziest part about that stat is over 50% of the time, economic growth was decelerating. So you have a situation where over 90% of the market gains are coming in less than half the time. And it's so important to monitor these cycles and growth. A prime example of this would be a lot of equity indices doubled. They were up 100% from the COVID low till now because economic growth was rebounding off the bottom. So we have these periods of time where we have massive moves in the market when economic growth is accelerating, and because of these secular trends, growth reverses, and then the market kind of trends sideways for a while. To the point that you were making about which assets do well, it's when economic growth is declining, growth becomes more scarce. So investors pay a premium for the growth that they can find. And when you look at the world that we live in now, the only companies that are able to have sustainable growth are really these big 5 tech companies. If they don't have growth organically, they just go out and buy it. So every time we see the market move to a regime of growth slowing, you see these big 5 tech companies or the NASDAQ get a monster bid because investors pay a premium for growth that they can find. And all of the sectors that are more linked to organic growth, like the Russell 2000, financials, industrials, they start to tread water or go down because their earnings are too sensitive to economic conditions. So it's a little bit counterintuitive when we talk about growth equities do well when growth is declining. It's just really the nomenclature, because growth equities is really synonymous with tech, and tech generally has, or at least the big 5 tech companies are perceived to have very stable growth that's immune to economic conditions, and therefore those companies get bid up when there's a scarcity of growth in the economy.
Yeah, you're not kidding. I mean, we have literally seen the FANG stocks carry the market, it feels like. But as you mentioned, everybody's looking for premium now in this interesting environment. And sometimes that even goes into SPAC mania world, right? And Chris Muth Jr. is back here with us today. Chris, I have some questions for you. As people are looking for premium within the SPAC world, I mean, I've got the Wall Street Journal here from today, actually, and it talks about, Buzzfeed coming public through a SPAC yesterday. And the stock jumped more than 50% at its highs before giving up all the gains at the close. Shares traded at $8.56, down 11%. It broke $8 today. How do we know what SPAC companies are like? When we're investing in a SPAC, how do we really analyze a SPAC and go, oh, this is going to be a quality SPAC, or should we not touch it?
Early on in the process, you can see if they have been successful at raising money from the IPO investors. So the first thing you tend to see is what's the size of the SPAC. So the really high quality ones tend to be somewhere between $250 million and $1 billion. A few are larger, but robust demand from the IPO market for the SPAC itself, and a successful history in terms of their own SPAC that they've done in the past. So experienced SPAC sponsors. And then they tend to have the connections and the capital themselves to bring a big pipe. There's no magical reason why when you raise, say, $250 million, that's a fit for what target you ultimately find. So the pipe, the private investments in public equity, is the structure wherein you will be able to kind of top it off. And so the really good ones, $10 billion fund as a $100 million, $200 million SPAC can put in a lot of their own money, or people that have really good calls on capital informally or formally with their own investors. So we look for kind of well-capitalized and well-connected sponsors that have already been able to raise a lot of money in this SPAC and have done successfully in the past. In the case of Buzzfeed, what was interesting about that, and nothing to disclose there, I was not involved, but they had extremely high redemptions. So when you look at deals that are coming at the end, and you can kind of, usually they're fairly unambiguous in that you can kind of see if something's way above $10, not that many people are going to redeem for 10. It's always funny. There's usually somebody that does. Like I would love to meet somebody sometime. They'll have 500 or 1,000 shares that redeem at 10, even when they're trading at 20 or 30 or something. It's kind of crazy. But for all intents and purposes, you can see if there's going to be virtually no redemptions, or if it's trading way beneath 10, there's going to be very high redemptions. They actually got very little capital from the SPAC process. Most people redeemed. And
just to jump in real quick, sorry to stomp over you, but this article went on to say investors withdrew about 94% of the $287.5 million the SPAC raised before Buzzfeed came public.
Yeah. So it doesn't really fit the kind of categories that the SPAC investment community was looking for. I mean, the really kind of off the run targets don't tend to do as well. This one basically failed in terms of the process. So two things interesting about that. For people who, and I'm a sleepy trader in terms of the secondary market. I don't really, I have yet to do anything clever to try to exploit this, but there are some weird dynamics with short interest when you have a virtually 100% or close to 100% redemption. In that they will tend to spike. There tends to be these kind of short covering rallies right after the destacking, which this one had, and then it kind of reverts to making sense. If you just remove the promote from the share price, the idea that they tend to kind of go back to about $8 tends to be a pretty standard market reaction to de-SPACed equities. I mean, it's trading at $7.91 right now. I just glanced at that after saying that. But kind of, so $8 is kind of the norm, and these spikes can happen when there's really high redemptions.
Yeah, that's really good point out. But so we're talking about SPAC has been the way for companies to go public, right? That seems there's been more SPACs this year, like within the last 5 years combined. It's been completely on a rampage. And then we just got the news the other day that American Express Global Division's going public through a SPAC worth or valuing the company at $5.3 billion. That's with Apollo. So my question for you is, should investors prepare for SPAC mania to continue into next year?
Well, in terms of activity, we already know there's going to be a ton of new deals in January and February. So, we are involved very early in the process. We're involved both as investors in founder shares and as a fund that tends to have a lot of the kind of testing the waters calls, which are the pre-S1 kind of early stage. And so we're just super, super jammed up. So it's going to certainly be busy. I can say qualitatively, subjectively, there's some really, really good, interesting deals that I think are going to come to the market. But I am directionally tepid in terms of my enthusiasm for the average one, right? Like I think this is a great area to be very selective. There are SPAC ETFs that we have never owned and we're often short various ways. Just in terms of the average de-SPACed equity, I think doesn't do that well, unlikely to do well next year, but the best ones can be terrific. So selectively, there's a lot of always interesting things to do.
Yeah, I think investors also might be worried about all the SEC probes that are starting to come out to SPACs, like Lucid, I know just recently had one, DWAC, I believe just had one. Is that something investors should be worrying about?
I think that's something investors should be enthusiastic about. I mean, I think it's the Wild West, and that there are regulators paying attention to what's going on is a good thing. One of the sensitivities is to make sure that there weren't negotiations before the S1. The nature of the S1 is that it precludes a previous deal, right? Because then it would have had to have been disclosed in that document. So I think that as long as it's kind of consistently applied and transparent, I think in theory the SEC is there to protect us, and in this case they might be doing that. We haven't seen enforcement action yet that I'm uncomfortable with as an investor. I think that you get a lot of press and speculation about what regulators are doing, but if you look at their actual enforcement decisions, I tend to be much more supportive of what they're doing.
Yeah, and let's just wrap this up with a SPAC segment. I just want to, for the audience members that don't really know much about SPACs, maybe just give a brief description as to why SPACs are so favorable in a period of time where a company could instead go do a direct listing or have an IPO. Why choose a SPAC over those other methods of going public?
Sure. And if you look at what Panera is doing, I think what we're going to find is that the traditional IPO process is kind of getting folded into SPACs in a number of different ways. So SPACs are the 21st century successor to the IPO. And what is more attractive about SPACs to outside investors such as me and to the companies involved is that it is market driven every step of the way. So they want to come to market. You want to sponsor a SPAC. We'll have a conversation that's really a negotiation about how you'll do that, what is in the unit, what securities that has to include for me to want to invest. That's a two-way, arm's length, nominally adversarial relationship where you're trying to, you have a bid and an ask instead of an advisor that just kind of has a number that they pull out of their ear as to how the IPO goes. So then you go to the IPO. And then once it IPOs, everybody else has a say. You're in the public market with a security, with a bid and an ask. When you talk to the founder, they can look at it and they can negotiate with the SPAC sponsor. And then the market has another look. And so at every step of the way, instead of something being subjective or arbitrary, it is market competition driven. So I think it's far more rational and leads to better outcomes. And it's ultimately better for the outside investor, and it's better for the founder that gets to observe all of this in real time and also move a lot more quickly than an IPO can.
Yeah, that's great. Thank you so much for breaking that down. Brad, I want to bring you into the conversation. REITs, as we were talking about where to find the premium in the markets and everything, we've been talking to you week after week about REITs and the real estate investment trust. Last week, we covered net leases. If you guys haven't had a chance to check out that segment, you can find it on Seeking Alpha's page. Seeking Alpha video page on Seeking Alpha or on our YouTube channel. But Brad, we had some feedback from our users that they don't fully understand the real estate investment trust area of the market. Now they've started to gain a lot of interest in it, the safe dividends that you've been talking about for some of these companies, the potential for nice retirement income or vacation income, whatever they might want to use it for. I was just wondering, could you take a moment and break down what makes these REITs so favorable to investors instead of, any other place to find potential income?
Sure. And it's great to be back on again. And first off, I want to say the first thing we do is we look at the macro news and what's going on, at the big picture. And I got to just say, I just subscribed to EPB Macro Research. This is not a paid commercial. I've been listening to Eric now 3 times in a row in these podcasts, and he does an excellent job breaking down macro level news. So great job, Eric, and I'm now a subscriber. So that's the first thing I do. The second thing we like to do is just look at, the real estate sector, the REIT sector, I should say, is very broad, covering many different, property sectors. In fact, a lot of these sectors that didn't exist 10 years ago are some of the best property sectors to invest in today. For example, cell towers and data centers, we call those the prop tech world. We have a number of other property sectors, subsectors of this net lease sector we talked about last week being the gaming sector. So a number of different ways to play it. So it gives you a lot of diversification opportunities, and an investor can really build their portfolio designed around their risk tolerance levels, looking at the macro picture, looking at things like Eric reports on supply and demand. All those things are really important, but you have to look at those individual property sectors when you're building your portfolio and designing, what are you looking for? Just income? Are you looking for total return? But overall, what really the magnet for REITs is the income. That's, again, I talked about this last week. REITs by law must pay out 90% of their taxable income. And that's what makes this sector extremely stable and predictable. Now, not all property sectors, we're seeing a little volatility in skilled nursing today as a result of labor shortages. And so some of the sectors certainly do have more volatility than others. And that's why each investor should, allocate capital based on their overall risk tolerance, building out their portfolio, looking at all the various different types of property sectors. And obviously, hotels for today are extremely more risky. We're seeing that volatility. One day they're up, next day they're down. And there's a lot of stability in a lot of those other sectors, especially those longer duration sectors, longer duration lease sectors that we report on, like healthcare would be one example, or net lease and industrial. So, but it's a very stable and predictable property sector, and that's really, I think, the biggest, value proposition for investing in REITs.
Gotcha. And let's say that investors come to you and they say, hey, I'm either risk averse or I love taking risks and they want to invest in REITs. Do a couple subsectors within REITs come to mind for each of those groups that they can then start exploring down further?
Yeah. So again, I think the biggest thing right now, especially in this environment that, again, Eric just talked about, inflation and rising rates. And so we really have to, think about those in terms of what's going on in the broader, the big picture. Inflation is definitely an issue, and it's, even though REITs have performed well in inflationary environments, we really haven't been in an environment where we're in right now today. There's a lot of different things out there that make this a different story than we can rely on in the past. So I think the one thing we look at is growth. We want to see not only that the company has a safe dividend, but it's able to grow that dividend at a fairly good clip. Again, we've got this inflation sitting there, so we want to be able to see not just some very modest, 0.5% increases, but we want to see very stable dividend growth. So what we do is analyze and really dig into the fundamentals of these companies to determine, is that income sustainable? Are they able to continue to generate the same earnings, which of course we call that adjusted funds from operations or funds from operations. So are they able to still generate earnings growth and income growth, which is the net operating income, the rental income for the property, and grow that dividend? Then we also look very closely, in fact, almost in a granular sense, the payout ratio. Again, we look at the AFFO, which is really the most, the proxy for that dividend, and before it's paid out to the investor in the form of a dividend. So we look at the payout ratio, which is the dividend divided by in our world, the AFFO metric, and we want to make sure they've got a good margin of safety, in that dividend payout, and they're going to be able to grow that dividend. And so looking at things along those lines is really important. Now, what's really interesting, and I just wrote an article about this today, and there's been since COVID began. There's been 5 different M&A deals, and these are REIT to REIT M&A deals. There's actually several private equity deals as well, where REITs have been taken out by other companies like Blackstone or KKR. But I want to highlight these, and this is important because we always like to talk about scale advantage. I mean, one thing about REITs own approximately 10% of all commercially held, institutionally owned properties in the U.S. I'm not counting houses, but just commercial real estate of institutional quality is held by REITs. So that means there's a lot more opportunity set, broadly speaking, for REITs to absorb or consolidate portfolios. But now we're seeing really through COVID, over the last, say 12 months, we've seen companies like Simon and Taubman, merge. We've seen companies like Realty Income and VEREIT merge. We've seen companies like Kimco and Weingarten merge. We've announced, and we're going to see in the first quarter, Vici and MGM Growth Properties merge. And then more recently, we hear about American Tower acquiring CoreSite, which is a data center REIT being acquired by a cell tower REIT, American Tower. So there's 5 deals. What that tells me is, and we own positions in all these companies, Simon, Realty Income, Kimco, Vici, and American Tower. And the reason we own these, and the reason we're going to continue to own these, is because we understand the game is all about scale. And you've got to have cost of capital to scale. So what we do is look very closely at the fundamentals of these REITs to determine their cost of capital, their liquidity, their balance sheet, so they can grow these platforms. And again, look at this M&A activity that was occurred just over the last 12 months. So that's a really good indication. I think investors should really be looking at, you want to own the big players, you want to own the consolidators, and watch them continue just to grind it out and grow and grow and grow. Because again, REITs still only own 10% of this huge universe of real estate in the U.S. and abroad. And so that's really the value proposition. But I would suggest to anybody watching this, always focus on scale and cost of capital. That's how you're going to win.
Yeah. And you mentioned in your note last week that industrial REITs has actually been the top performing subsector within REITs. Do you think that this is going to continue?
Yeah, I'll tell you, I think one of my biggest mistakes, and I've had plenty, believe me, well, one of my mistakes in COVID was I should have just backed up the truck on industrial. I didn't. Now, we did buy a lot of good companies during COVID, and we've done really well coming out of that. It's not hard if you bought at the very bottom, obviously, and there's a lot of success stories out there. But I wish we had invested in companies in March or April of 2020, like Prologis, which is the big giant consolidator. Notably, that is not a consolidator on the list that I own. I wish I did. I wish I would have bought more. Now, we bought companies like Stag Industrial. We've owned Stag about almost a decade. The company actually went public just around 10 years ago. And Stag's been a great pick for us. They've been able to consolidate. They're a little differentiated because they don't own some of the big LA market assets, and they're in more secondary markets like Greenville, South Carolina, where I'm sitting. That's their third largest market. But the industrial sector has just been on fire. And a lot of that, and I just wrote an article, which will be published, I think, tomorrow on Seeking Alpha, is the fact that, this e-commerce has really driven the demand for a lot of these last mile facilities. So these are companies like Amazon and FedEx and UPS and some of those buildings that are even the retailers that operate these logistics facilities. That's really what's driven the demand, is the e-commerce, and COVID has really accelerated that demand. Now, what's happened, though, is these companies have become expensive. Again, going back to pricing power, cost of capital, now the average multiple for the industrial REITs in general is around over 30 times, compared to is about 20 times about 5 years ago. So you've seen a big spike in terms of valuations. I think we only have one buy on our entire industrial list, and that's a really unique company called Americold, which invests in cold storage. Now, they've sold off again because of the supply issues and the labor issues associated with cold storage, which has a service component to the business model. But overall, industrial has been a great place. Unfortunately, they're just all too expensive right now, except for a few outliers like Americold. But I think that's going to continue because you're seeing, we went through all the third quarter earnings calls, looking at what the companies had to say, and you're seeing just accelerated rent growth around 10%, even 15% in some markets. So tremendous pricing power. Industrial is definitely a great place to invest in. It's just very, very expensive right now.
Yeah, sounds like a vicious circle between inflation and wages going up and the cost of goods going up, and we'll see where that ends. But gentlemen, thank you so much for the engaging conversations today. Before we get out of here, I'd love to do a final trade segment with you. People seem to really like this part of the show. So we're just going to go around the horn and, throw out a name that you're recommending to investors right now, whether it's something that's on your own mind or something that you've been doing research on. So Chris, why don't you go first for us?
Sure. Planet Labs is a new security that's going to be trading tomorrow for the first time, ticker PL. It is getting de-SPACed from an existing SPAC, ticker DMYQ. I'm long it, or will be long it tomorrow when it starts trading. I think it's just a spectacular, important company. Subscription, miniature satellites that have daily imaging, highly detailed imaging of the whole globe. That's going to be extremely useful, I know, to hedge funds such as mine, insurance, a myriad of other industries. I think it's extremely valuable based on some of the kind of trading attributes of how SPACs tend to work. It's fairly close to its trust value right now. I think it's worth a multiple of that. I think this is the kind of thing that could easily double or triple in public markets in the days ahead and months ahead. So Planet Labs, ticker PL, I'm long and glad that I am.
PL, copy that. Brad.
Yeah, so I just went to our screening tool at iReal Alpha, and we've got a number of strong buys here. I'm going to go with one of the higher risk names, and this has had a lot of conversation on Seeking Alpha, so it's probably no surprise. I'm going to say Omega Healthcare Investors, that's ticker OHI. Now, again, this skilled nursing sector, and I alluded to this earlier here on your show. It's a higher risk, certainly more volatile sector. probably the most volatile sector in the healthcare industry. But we actually published a note last night on our marketplace service. Care Trust was actually reported yesterday. Bloomberg reported potential discussions for potentially the company being sold. There's going to be potentially some private bidders out there for sure, but I think Omega, of all of the healthcare REITs, we think Omega Healthcare OHI is probably the most logical buyer of the in the publicly listed REIT space. Now, of course, M&A should never be a catalyst. We think there are plenty of other catalysts, and the primary one, again, going back to that macro conversation, is just that silver tsunami, that aging population that we're seeing out there that's going to catch up, and occupancies are continuing to normalize in skilled nursing. This company is trading at a pretty substantial discount, no matter whatever multiple you want to look at. The dividend yield right now, which is probably the most retail investors look at the dividend yield, which is about 9.1%. The company has covered its dividend in the third quarter. The question is, will these operators be able to hang on? The question is, will the government still continue to provide support to these skilled nursing operators? A lot of questions, a lot of risk, but we think Omega Healthcare Investors is definitely a strong buy, and we're going to maintain that.
All right, and the king of macro himself, Eric.
Yeah, and thank you, Brad, for some of those earlier comments. And I promise we're not just backslapping each other here, but I talked about sectors that do well when growth is accelerating and growth is decelerating. And I get asked about REITs all the time. And REITs is one sector that I usually punt on because it's such a broad and diversified sector that there are some really cyclical REITs that get absolutely hammered when growth is slowing. And then there are some REITs that do really, really well when growth is slowing, or vice versa. So REITs is a sector that you definitely need to consult someone that can dig into the fundamentals in the specific company. Whereas something like financials, XLF or KRE, regional banks, I could say pretty cut and dry. When growth is increasing, financials do really well. When growth is decreasing, financials do horrible. It's not so black and white with REITs. So that's one thing to keep in mind. As far as I'm concerned, whenever growth is slowing, you want to be long the longest duration that you can find. For me, in the macro space, that would be the longest duration treasury bonds that you can find. Depending on your risk tolerance, these are treasury bonds, but doesn't mean they're not they don't have volatility and risk. Like if you go out there to a ticker like ZROZ, you get almost a 25, 26-year duration. And since March, this inflection in growth, it's only about 9 months, but ZROZ is up almost 27%. And that's a treasury bond. A little bit low, 25-year duration would be EDV, and TLT is probably the most common one, about an 18-year duration. But as long as growth continues to slow, which my work says that it will, you want to be long the longest duration that you can find. And I'm coming out with my monthly cyclical report, and investors that will get a full chart book of all the cyclical trends that come along with that too. So for me, as long as growth's slowing, you want to be long the longest duration that you can find.
Fantastic. And thank you again for joining us, everyone. This has been Chris Demuth Jr. from Sifting the World, Brad Thomas from iRead on Alpha, and Eric Bazmachin from EPB Macro Research. All of their services are found on Seeking Alpha Marketplace, so make sure you check it out, and we'll see you in the next program.